Welcome guys, thank you for joining us. I'm gonna breeze through the whole introduction part over here. We have a lot of new faces. I'm gonna ask you if you can actually, once we reach 50 people, if you could create a new stream and just stream my thing, that would be great. But yeah, so you guys know me as the Market Bishop. My name is Kevin, feel free to call me that. Over here you have my buddy, my business buddy, whose name is JP, which you guys see as the agent. The great thing about live sessions is it's all free educational content. We record all of these and we post it on our YouTube. The great thing of why live sessions is great is because you have two perspectives here. You have my perspective from my 11 years of trading, and you have JP's perspective, who has, I think, almost 21 years right now. So I'm more of a technical analysis trader, while JP is more of a fundamental trader and was taught by a lot of old, like, big mentors. If you guys remember, yesterday we had Ray Pitts come on, not yesterday but last live session. So he has a lot of connections, he's learned from a lot of guys, and I'm over here and I just learned from my experiences. So you have two great perspectives you can hear. So today, basically, what we're going to talk about is Fibonacci retracements. The whole title is Fibonacci Retracements Made Easy. And the reason why I wanted to bring up this topic was because a lot of people, I'm in numerous servers, and from time to time I get a lot of pings, so I had to go through the chats, and some things I see are pretty insane, because half the times, not even half, 90% of the times, I'm going to be kind to you guys, a lot of you guys don't know what you're doing, whether it's just charts that don't make sense, technical analysis that doesn't make sense. So it's really important to learn things that have been proven to work consistently time over time, and Fibonacci's is one of them. So we'll just get right into it. And by the way, I took a lot of time writing this up, so I hope it's easy for you guys, because that's the whole reason why I wrote it down. So I hope it's easy for you guys to understand. So what are Fibonacci retracements? Basically, they're levels based on numbers that appear frequently in nature. So it's a mathematical kind of thing here. And why they're important is because they've been proven to work over and over again. They're patterns, right? It's basically finding patterns that you could find in nature, in human beings. And one thing that I've talked about time and time again is humans love following patterns, even if we are intentionally trying to or not intentionally trying to, whether it comes to our routines in the morning, at the night, or even when it comes to trading, right? We're trying to read patterns, and that's just how humans work. So why do they work, right? It's universally recognized pattern in nature and trading. So obviously, if it's universally recognized, you can expect hedge funds, whales, and retail traders to start using that as a tool or something to look at while they're trading. And because of this, you start getting collective behavior, which is something you want to go for, right? If, for example, you're looking at a pattern or something on the chart, you are betting that other traders, especially the bigger traders, whether it's hedge funds or whales, are also seeing what you're seeing, because then they'll get into the same trade as you, and then the likelihood of that trade working out increases, right? So when can you use them? Well, first of all, you can use them all the time. First, to be able to do that, you need to be trading or using Fibonacci's in a trend. It's not really used the best in any range kind of market. When you identify a trend, that's when the Fibonacci's are really great to use. And the cool thing is, we're actually going to go over like very basics of how to identify a trend, since it's important for Fibonacci's. So you can use this both on the bigger, smaller time frames, but the bigger the better. So what I mean by that is, the bigger the time frame, the more value it holds, but we'll get into that in just a second. It's the best for swings because Fibonacci's are used more by traditional traders, and more traditional traders are swing traders, right? Not so much day traders. So you will see a lot more success when you use Fibonacci's for swings, but it's absolutely possible to use it for day trading as well. And we'll get into examples later on. So there's two types of Fibonacci retracements. These are terms I have, so I can easily understand and you guys can easily understand it. The first one is called bullish fib retracement, right? This is when you have a bullish trend. So the starting point is the low and the end point is the high. So what I mean by that, if we zoom into this picture right here, if you look at my beautiful drawing of, I don't know what chart this is, we'll just call it Tesla, you could see the price is increasing, right? So you have a bullish trend, and we're trying to figure out what the start and the end point is, right? So the starting point for a bullish fib would be low. As you could see here, this is the low here on this chart where you can see my cursor. And the high would be the most recent high, which is the end point right over here. And if we were to draw it, we would get a fib looking like this. And again, it's an ugly drawing, but you get the point of it. We'll get into more things to make it more simpler. But the next kind of fib retracement is called the bearish fib retracement. This is for bearish trends, right? Basically the opposite of what we went over. So the starting point of the fib that you're drawing will be at the high point, and the end point is at the low point. So if we zoom into this example over here, you could see starting point is at the high, end point's at the low. If we were to draw it out, it'll look something like this. All right. So the next thing you're trying to identify is what the trend is. We're not going to go too deep into it because that's a whole live session that could take an hour. But we're going to go over very simple basics. So for a bullish trend, you guys have heard this before. It's pretty simple. If you've not, let me just say it again. When you're in a bullish trend, you would want to find price action making higher lows and higher highs. And when you're looking at a bearish trend, you'll be looking for price action making lower lows and lower highs. You can use other kind of indicators if you want to use indicators to also help you identify the trend. So we went over the MACD, I think 2 live sessions ago. JP went over it. He talked about how it helps you kind of figure out what the sentiment is and when it's possible there's going to be a reversal, right? So it's sometimes important to look at the MACD. We briefly went over the RSI, but RSI is definitely usable with Fibonacci's. And moving averages, again, JP went over that, but we went over that briefly. Both the RSI and the moving averages we will be going over in another live session another time. But whatever strategy you personally use, you can kind of tie that in with finding confluences with the Fibonacci. So if you guys remember, earlier I talked about bigger time frames, right? So let me just read this out for you. So bigger time frames hold more value and importance than smaller time frames, but smaller time frames lead into bigger time frames. I'm just have one small example here. So for example, if a bigger time frame on, let's say, Apple is making lower lows and lower highs, you would call that bearish, right? But if the smaller time frame, let's say the bigger time frame we're looking at is the daily, but the smaller time frame we're looking at is, I don't know, the 1 hour, is starting to curl up and it's making higher lows at an important level, that's when you can think to yourself, okay, this smaller time frame could probably lead into making the bigger time frame have either a reversal or actually change the trend into bullish, right? So it's important to know it's not just like, bigger time frames are the only thing you look at. You want to look at bigger time frames, but you also want to look at smaller time frames to have a better chance of becoming efficient with your entries. That's what I personally do, right? If you guys have seen my swing trade, I don't go just according to the daily. We gone over this multiple times. I look at the daily, I look at the 2 hour, the 30 minute, right? That's why my process takes a little bit longer. But that's why a lot of our entries, unfortunately, it wasn't the case last Friday, but a lot of our entries have been very on point. It's because you tie in both the bigger and the smaller time frames. So remember, both time frames are very important. So next thing we're going to go over, and again, if this is by any means confusing, don't worry, it's going to become very simple. We're going to go over the levels in Fibonacci's. They're called ratios. So before we go into the different levels, the one thing you want to keep in mind is the starting point and the end point. When you draw a Fibonacci, the 100% line will be your starting point and your 0% line is your end point. Just keep that in mind. Now, moving to different type of levels that are used in the Fibonacci. The first one is going to be the 23.6 fib, right? This is usually a shallow retracement. It's a minor pullback. I personally don't, we'll go over the settings I have and everything like that, but I personally don't use this level just because you could see here I said shallow. So for example, if the price were to retrace to that area, there's a lower chance that the reversal that we are going to get into or trying to get into is going to either work or either last long, right? So you guys know me, I don't like getting into small, short trades. I like getting into bigger trades. So that's why I personally don't look at the 23.6 Fibonacci level. The next one is one of the more common ones, if you guys have probably heard. It's probably it's the second most common one. It's the 38.2 ratio. This is one of the most common retracement levels. This is for stronger trends. So what I mean by that is, obviously if you're seeing price, if you're seeing price increase, right? The retracement wow, let me repeat that. If you're seeing the price increase of a stock and it's a very strong, price action to the upside, it's a very strong trend, it's highly unlikely that the price will drop down here, right? What you'll probably see is the price will just keep on rising and it'll make short retracements, right? And you would want to enter off of the short retracements. Well, the 23 is just too short. This is too small. You could find yourself getting in 23 around this area, this area, this area, and you're just going to be held in a lot of pain. Versus the 38.2, and you see the significance of it, is a little bit lower, and it's next to another crucial level. So 38.2 is a level you want to look at, or a ratio you want to look at, when you have identified that a stock is in a very strong trend, right? You want it to reverse off of that point. The 50% ratio is not a fib retracement level, but it is a psychological significance as a midpoint. So this kind of ties in with the 38.2. It's why it makes the 38.2 ratio a little bit more valid than the 23.6, is because psychological levels and psychological numbers are very true in trading. And seeing that is going to, and if a collective amount of people are seeing the 50 and the 38.2 and the price is coming between these areas, there's going to be a higher chance that price reacts, right, in the way that you're looking at it. The next two is something that's going to tie into a little bit more important. The first one is the 61.8, which is called the golden ratio. This is the most strong, this is for like any strong retracement you have. Majority of the times, not all, because nothing is guaranteed in trading, but majority of the times you will find the 61.8 ratio acting as a very strong support or resistance. So what I mean by that is, let's say the price knocks down past the 38.2 and the 50 ratio, but you have identified the trend before the breakdown was pretty strong, you'd want to look at the 61.8 for a possible bounce, because there's a higher likelihood chance that it will bounce at that area. Even if the trend is no longer there and valid, there's sometimes a dead cat bounce in a bullish scenario that will happen at the 61.8 ratio. So it's a very important level to look at. Then you'll see 78.6 ratio, which is for deeper retracements. It's a higher risk area and chances for reversal are slimmer. And I'll show you why in a little bit. But I mean, think about it logically. If you have a strong trend and then all of a sudden the price, comes down almost 78% of the entire trend, is there a highly likely chance that it's going to reverse, to the upside at that level? Not as much compared to the levels we talked about, right? So you could see over here, I have something written out here that says golden pocket. What this basically is we talked about the golden ratio, which is the 61.8, but the golden pocket basically ties in the 61.8 and the 78 ratio. And that area becomes like, you could call it demand zone, supply zone, whatever you want to call it. It's just an area of interest. And between those two areas, there's always going to be a higher chance that the price will go breach the 61.8 and actually bounce between or somewhere around the area of 78.6 and 61.8. In fact, I have actually some examples below where you'll see that happening. So very important to keep an eye on. So for example, I just drew out a bullish fib, right? You can see the price is increasing. And as I said before, the starting point fib levels are going to be the 1 versus the end point is always going to be 0. And you can see the levels in between: 0.236, 0.382, 0.5, 0.618, and 0.786. When you draw this on TradingView, for example, it's going to show us decimals. It is not going to show us percentages. So just keep that in mind. In case you get confused, they are going to show up as decimals and not percentages, but they're basically the same thing. Also, one thing you can see here, I wrote out the 38.2 and the 61.8 in red. That's because those are the two primary fibs I personally look at. And the pictures we go over, you actually see that I don't really have any other level past the few ones that I really focus on, right? Each person has their own strategy. You can have all of them. I personally don't want to. I like less clutter. So anyway. So the next question you might be having is how to find the end and starting points of the fibs, right? Because how do we draw it? How do we figure out where to start the fibs? So it's very simple. You have to basically find the most recent swing high and swing low. If you don't know what a swing high is, basically it's the highest point or the last higher high in the area or time frame you're looking at, versus the swing low is the lowest point or the last lower low in the area or time frame you're looking at. So here's an example of PG, right? This is a 30-minute chart on PG. PG is an amazing swing stock, and it's considered you could almost call it like a safe haven or a recession-proof stock, but it's pretty nice to swing. It's not as volatile. TA usually works out. So anyway, looking at this chart, we want to just quickly figure out where the swing high and swing low is. So it's very simple. We talked about how, the swing low is the lowest point on the chart. So that's just going to be over here. Very easy, right? And the swing high is going to be the highest point, which is going to be over here. You don't want to be looking at this, at this, at this, at this, right? If you have this whole chart available to you, then you want to only be looking at two areas, the swing high and swing low. If, for example, you're not, you only have, let's say, the current area, the current price is only before this white line right here, then it makes sense to consider this area right over here a swing high, because this hasn't passed, right? You haven't reached that point. So then this would make as a swing high, right? All right, moving on. If we were to go according to that PG chart we were just talking about, and we draw a fib, a bullish fib, right? Because this is a bullish trend and we're trying to get into the bullish price action. You can see here the starting point, which is the the starting point, which is the 100 or the 1, which is the low over here, and the end point, which is the 0, which is the high over here. And you can see the fib levels in between. As I said before, I only look at the 38 and the 61, and I just have the 0.5 as just a reference. But you could see how well it really works here, and how you had to really tie in a lot of not a lot of things, but a lot of confluence, or a lot of you need to have more logic, and you can't just look at fib levels and enter right off of them. So you can see here, a few times PG bounced off the 0.5. You could have taken entries off of that. This movement right over here, if you took a day trade on it, this would have resulted in 20 to 40%, depending on the day you took the contract. You could also see here when PG came down below the 50, that signifies that it's going to break down most likely to 61.8, and that's exactly what happened. Well, I said happened. But you could see here, PG came to the 61.8, and as we said, sometimes when it comes to 61.8, it's a very strong level, but doesn't necessarily have to bounce right off of that point. And you can see that right here. On the 30-minute, you can see that the price slightly breached below, but then came right back above the 61.8, and it ended up tracing all the way back up to the 0.5. This trade again, 20 to 40%. Again, we have the same situation here. Retracement down to this level, another day trade you could have taken, this probably would have been 20 to 30%. One thing I wanted to point out is the whole golden pocket ratio, right? So I unfortunately don't have the the 70 level, the 70 ratio, but you could just imagine it to be somewhere here, right? And you could see that the price of PG retraced below, or pushed below, the 61.8, hesitated in this area, and then came back up. And the reason why the golden pocket is sometimes a really good area to look at is if the 61.8 had a failure to hold, right? The price action could not hold above or below that area. If price were to push into the golden pocket, usually the move that happens and reverses after it breaches into that pocket is pretty strong. And you could see that here in the example I have of PG, right? In all the examples we see here, these trades, if you took day trades, would have just been 20 to 40%. This option trade right here would have been 50 to 70, depending again on the day you take the option trade. So keep that in mind, right? You want to make sure you're paying attention to the right levels at the right time. We're going to go into another example. This is another swing example. We'll pick up Nvidia, which is one of our favorite stocks to trade. So right here, we're looking at the 5-minute. We're going to identify the swing lows and the swing highs. Again, since we're looking at this whole area over here, we're going to look at that. If we didn't have this area and we only had price, like let's say it's whatever day this was, if this was the 17th, then of course this would be the swing high. But, you know, since today is today, the swing low is down over here and the swing high is all the way up here. So the reason why I'm showing this is for people who can't identify swing highs and swing lows. It's very important not only in Fibonacci's, but in trading in general. So it's very important to identify what the swing highs and the swing lows are. And this is, of course, where it will help us be able to draw the fibs. Again, if I go back to the top, I'm so sorry if you guys are along with me, but I just want to make sure I nail in your head. The way you draw it is the starting point for bullish fibs is the low, is the starting point, and the end point is the high. And for bearish fibs, it's the opposite. The starting point is the high end, and the end point is the low end. Right? So let's go back to the drawing. All right, so we figured out what the swing high and swing low is. Now, if we draw out the fib, you could see this is starting point, which is, and the starting point, which is 1, is all the way at the swing low, and the end point, which is 0, is all the way at the swing high. And you could see here, actually, near the end of today, Nvidia bounced off the 0.38 ratio. So what does this mean, right? We have two things we can look at. If you guys have been here before on the live sessions, you've heard me always talk about the wicks and how it's the most important thing when it comes to reading candles in my experience. Now, we haven't had a solid video on price action, but that is something that will take a long time to explain, especially because I have a very unique perspective, which has given me a lot of success. So that's going to be a video for another day. But to look at this very simply, you have two great things that's going on here. So, and I'm getting a few questions. The way this is going to work is I'm going to go through this whole thing, and then I'm going to show you the pictures here, and then I'm going to go over live examples with you guys, so you guys will be able to pick the tickers you want me to look at, and we'll figure out is there a fib available or if there's not a fib available. So don't worry about that. So there's two things that's going great and what would make me bullish on Nvidia. If we don't even look at this chart, and if we just look at the market as a whole, we already know, like I've been talking about over and over again, the Nasdaq and SPY has been independent in the 2-hour and the daily, and we're finally breaking out of it. So our sentiment will be lying heavily more on the bullish side versus the bearish side. So now looking at Nvidia, you could see here from the 12th all the way to today, we've been consistently making higher lows and higher highs, which means that we are in a bullish trend. Of course, trends are absolutely going to end at some point. But if the trend is strong, there's a higher likelihood that the trend will continue. You guys have obviously heard the saying, don't fight the trend. That is a very true thing. Don't ignore that. So two things we like here, right? Or I like here. This candle right here on the 5 minutes or 10 minutes before close, it closed very nicely because you have a very nice wick to the downside, which represents the strength of the buyers at this point. And then the second thing you would like is the fact that this closing candle on Nvidia is very strong. It's not as strong as this one. Actually, you know what? It actually is stronger because we unfortunately do have a very high wick over here. But if you had concern over entering because this wick on the last or the second last 5-minute candle is pretty big, this last 5-minute candle should be your confidence point because you're seeing that the candle is very full. It has a nice body, and in fact, even though the wick is small, it does mean that price retraced just a little bit, and it was able to pick up a little bit more buyers to help push this Nvidia up. So if let's say you were looking at Nvidia near close, if I was looking at Nvidia near close, I would have gotten into, I would not have mind getting into Nvidia calls as a swing because it's bouncing off a fib and it's, matching a lot of criteria I like, right? Now, since I'm talking about bullish stuff, I'm going to go over a bearish example. This is the Oxy daily chart. First thing we're going to do, just right off the bat, we're going to identify the swing low and swing high. we can already tell the swing low is this area versus the swing high is this area, right? Pretty simple. Let's say we're looking at Oxy and we're like, hey, you know, even though the trend was bullish before, I mean, yes, it did create some significant waves to the upside, but this movement to the downside is very strong. You know, you see this bearish candle right here, you're seeing consistent downside, and then you're seeing these strong bearish candles, right over here, right over there. So let's say you're bearish on Oxy. You believe the trend to the downside will continue more than the trend to the upside. So let's draw a bearish fib. Using that same chart, you can see here, we drew the fib according to the levels we talked about. So let me go back to this actually. So we identified the swing low and swing high in this area, right? But this swing low is something we necessarily won't look at, because when you draw fibs, you draw it from left to right. You can never draw it from right to left. So we've already talked about how when you draw a bearish fib, your starting point is going to be the swing high, right? So if we were to draw it to all the way to swing low, that invalidates our fib because we're drawing it from right to left, which is wrong. We want to be drawing it from left to right. So what that means is, since we're looking to draw a bearish fib, we need to find the swing low that is to the right of our starting point. Our starting point is going to be the swing high, right? So if we look over here, if we zoom in, our next swing low, since we're looking at a bearish fib, is actually going to be this candle right over here. So this is the two starting and end points we're looking at when it comes to this bearish fib on the Oxy daily chart. Now, if we go over to the second picture, if we draw out according to the swing high and swing low we're talking about, you could see the starting, which is the one level, is this swing high, and the end point, which is the swing low, which is down over here, which is the 0 level, is our swing low, right? So we're starting points over here, end points over here. And you can see when we draw this fib, lo and behold, multiple times this fib held its place, right? You could see that Oxy came up to the 38 fib and then hesitated here. It rejected not only once, but it rejected twice, over here and over here. So if you didn't want to enter, if you didn't want to enter on a candle like this and you want to wait for more confirmation, this second candle right here would have been your confirmation, because you got 2 rejection points at that fib level. So if you were to take puts, and let's say additional to the daily chart, let's say 30 minutes also looking bearish as well. If you were to take puts, after the closing of this day, you'll find yourself in a significantly profitable trade, right? This on a swing trade, since Oxycon's moved pretty nicely, would be, depending on the expiration you get, would be probably 80 to 100%, and if not more if you go for a closer expiration. Now you can see here I drew this channel because it's technically in a channel, and you could see that once again, once it tests the bottom of this channel, Oxy comes right back up, and yes, it does breach the 0.382, but that ties into why I made a video previously, or I had a live session previously, of why I wait for the last 10 minutes or the last 30 minutes, because a lot of times the daily candle changes significantly from midway to the day all the way near close. And you could see here, you can guess that the daily candle was looking extremely bullish. I think it was like midway, or even I think it was like 1 hour before close. It was looking very bullish, and then some news came out, I believe, and then Oxy just completely tumbled to the downside. And look what happened. It's basically closing almost below the 0.382. And let's say again, that is not enough confirmation for you. That's absolutely fine. The next daily candle should tell you what you need to see, because you're having the candle close below again the 0.382. It rejects this area over here, and if the 30-minute is also looking bearish additional to the daily chart, you could have taken puts and you would have been in this trade, which would have been probably like 40%. Obviously the bigger trade was over here, but this is just another example I wanted to show you. You might be thinking, hey, Kevin, you're kind of nitpicking charts that you looked at. Yeah, I mean, absolutely. But these are literally, I searched up 4 tickers before coming on this, live session. I looked up Nvidia, Oxy, Uber, and what's the other one I was talking about? PG. So it was not like I actually nitpicked. I think I looked up 5 tickers, and 4 out of the 5 tickers followed fibs. So It's nothing really that I'm nitpicking over here, and we'll go over live examples. So then your main question is, how do we find entries? Finding entries on trades is never going to be something simple I can ever explain to you guys, because I'm not a financial advisor. I can only explain what's worked great in the past for other people, for me, or what other educational content says. So again, this depends more on you and what strategies you use. For example, I use only price action and volume. So you could see here in parentheses, if I'm looking at a bounce off of a bullish fib, I might want to look for candles that represent a candle that goes more to my criteria, right? A strong candle with a wick to the downside, which represents for me that the buyers are strong. And then, or, another example is a strong candle like this. So these are things I'm looking at when it comes to reaction off of Fibonacci levels. The next one, which is actually pretty easy to use, is the RSI and price divergence. A lot of people misuse RSI, but it's very simple to use. One of the most important things you want to look at RSI is the price and the RSI divergence. So an example right over here is, let's say you're looking at a bullish fib and you're seeing price making lower lows. As you can see over here, we made one low here and we're making another low over here, but the RSI makes one low, but then the next low, which is around this point right over here, is actually making a higher low on the RSI. This represents that the strength for the sellers is dying off and it's more strength on the bullish side, right? So you can kind of tie that in with a fib level. If you see price coming to a fib level and you're seeing RSI divergence, that's something you can look at. You can also, I didn't write it down here, but you can also look at, and that's actually pretty much the end of this presentation until we go into live examples. There's another few things you can look at. You can look at the MACD. Again, we have a video where JP beautifully explained it to us, so you could check that out. You can kind of tie in what you see in the MACD with Fibonacci's. And when JP was talking about the MACD, he talked about how he's found more success with it when it's come to swing trades, so that's something to keep in mind. You could also use SMAs, EMAs, moving averages, whatever it is. Basically anything you use right now, except bullshit ICT concepts, you can tie that in with Fibonacci's and you could find a lot more success in your trading, right? You could potentially find that, because this, again, Fibonacci is not just something that's been around for 2 years. This has been something which has lasted for almost a century, if not more. If you guys didn't know this, you should learn the history of trading, because you can learn a lot about how the market works if you do that. And trading didn't just start with stocks. We were talking about stuff where rice, grain, oil, all these things were traded before. And for traders back then, centuries ago or decades ago, the way they would figure stuff out is by actually drawing out a chart of the historical price points of the, let's say, grain, right, or rice. And they would actually figure out what patterns they're seeing, right? Because again, I've said it so many times, patterns are not bullshit. You are completely dumb if you think that. Patterns, we as humans follow patterns. So if we as humans follow patterns intentionally and unintentionally, you're definitely going to see that on charts, and patterns are a thing. So that's why Fibonacci's, since it's a mathematical thing and it follows the patterns in nature and humans, it is something that is shown to be proven once again multiple times that it really works. And it doesn't work 100% of the times, but it works a lot of the times if you tie in your confluences and your awareness of what's going on. All right. So what we're going to do now is, you guys could go ahead and put tickers in the main chat, and I'm going to go over some of the tickers you guys post, and we could look at live examples to figure out, hey, is this a great place to use fibs? Is there fibs available? So on and so forth, right? All right. So, of course, the first ticker that's asked is QQQ. No hate on that. It's just it's pretty obvious at that point. So let me bring up my keyboard here. Give me a second. So let's go to QQQ. All right. So right now we are on the 30-minute chart. Should we move on to daily? Let me see if there's a fib here I can look at. I mean, just looking at this chart, you guys have already identified, we're making higher lows, we're making higher highs right? The higher lows was created after we breached this area, and the higher lows has just been creating ever since, you know, the start of the swing low over here. So the trend is bullish. So what are we looking at here? Now we want to look at bullish fibs. So the way I'm going to actually show you how the fibs look. So first of all, wow, my Indian accent kicked over there. To find the fib tool, what you want to do on TradingView is you want to come to the left side and you want to go to the third button over here, and you press this arrow, and you'll see, for me, it's fib extensions that's showing up first, but you will see to fib retracement. So you click on this tool. I'm going to just draw one out really quickly, and I'm going to reset this just so you can see how it looks like. This is how the default fib looks. To me, this is very, very noisy. It looks like the pride flag. I'm not about pride flags. That's just me. So I want to simplify this. Again, you guys could do whatever you want. This is the way you want to use it. But I'm going to show you how I use it. So first of all, I'm going to just go over to a template of what I have so you guys can see it. And you can see the differences. So you could see here before I change it over to the template I have, there's a lot of fib levels you can look at. Something I will personally say, which you can choose to ignore, is I personally do not find a reason to keep any level above 1. The reason why is because there are levels you can look at, but most likely you will find a lot more use looking at the levels between 0 and 1. That's just personally what I've found, because you know, looking at these levels below just really isn't that important. You can have it if you want, but yeah. So we're gonna just go over to the template I have. Whoops, I almost deleted it. Which I just called it new. I don't know why, but you could see the settings here. I only have a few enabled here, right? You could see that I don't have the 0.236 or 0.78 because the 0.23, as I said, you could it's like usually for shallow retracements. You know, if you're really risky and you're totally for taking on risk, maybe you want to look at the 0.236. Me personally, I don't like looking at it. So the 0.786, the reason why I have it off is not because I think it's invalid. It is definitely to a point valid, right? We talked about how it's definitely a riskier entry point. But the reason why I have it off is because you could kind of guess where the golden pocket is. Again, the golden pocket is between the 0.618 and the 0.786. So you could kind of inference where the golden pocket is. And I do not want to really have much noise on my chart. So I personally just have it off. And I just know in the back of my head, you know, if the price creeps below here and I start seeing bullish, because we're looking at a bullish fib right now, if I start seeing bullish indications or confirmations, then I know it's in the golden pocket, right? Of course, if it's all the way down near the 1, that's not the golden pocket because that's way below the 0.786 ratio. So these are the settings I have. I personally turn off the extended left lines and right lines. Again, I don't want to have too much clutter. Things change all the time. You can have the trend line on that just shows where you drew it. I have it off because I just personally have it off. There's a background. You can have this on. Usually it'll be around like this way. I personally turn it off because, again, I don't like clutter. These are the values of the settings I have. I just like having the values on the center. I think default it starts out with the area with the price on the right side, but again, this is all customization you guys can do. And reading this fib right over here, you could see the levels of the fib is these decimals, and the number next to it in parentheses is the price where that fib level lines up with. All right, so going on to QQQ, you could see that the swing low is over here and the swing high is the recent high we made. So if we were to draw a fib extension, or not fib extension, or fib retracement here, these are levels I'm personally looking at. And what we're seeing here is if QQQ were to retrace, the fib level, the 0.38 and the 0.618 are levels that we're going to be looking at. So now the cool thing is if you actually look back at QQQ, you'll see here that the 0.382, again, we're taking a swing low, a swing high that was just recently created, right? It's actually reacting to this level multiple times. And this comes to show you that even though this fib, by the way, would not have existed before today, right? Because if we drew this fib before today, the swing high is all the way, here or here. So you could see here that the fibs really work because this level is not a level we have. And we could see that even with this new fib we drew out, we see the price reacting to this area. So we could kind of signify that, okay, all right, 524.61 is a price I want to look at, and 515.09 is a price I want to look at. So if we select a fib and delete it, these are two levels we want to look at for possible reversal trades into the upside if QQQ were to retrace. Now, let's go to a previous example of QQQ. Let's say, where's the rewind feature? Give me a second. All right. Let's say we're looking at QQQ, right? We're seeing this bullish trend beforehand. We want to get into calls. We identified that this is the swing low. This is the swing high. We move it over, and you could see multiple times where you could have used the fib levels and the ratios and the golden pocket to come out with day trades on QQQ. You could see here that the 0.38 really didn't hold, which means the bearish trend that's coming is pretty strong, right? Because we broke right past the 0.38. And then we hesitate around the 0.5. These could have been small day trades if you traded 0 DTEs. You could see the next day we, gapped down, but we've held above the 0.618. We broke all the way above the 0.382. We came back, we retraced, and we bounced off the 0.5, and then we bounced back up. So then your next question might be, okay, what if there was actually a fib here during the day? And that's absolutely true. Let's check out. If we draw a fib here on QQQ and we draw it out, you could see here, let me move it over, that if you drew out on the same day this bullish fib, you'll see that QQQ came and bounced off the 0.5 ratio. So you can use it for day trading. It absolutely works, right? But, oh my God, I need to undo all of this. You could see how the bigger time frames and smaller time frames kind of tie in with each other. And you can see multiple times where you could have used the fibs to enter into day trades with QQQ. Now, just to let you know, if you guys didn't know this, most of you guys do, but I'm going to quickly shout this out. You can change the drawings you have to only show on certain time frames. So for example, this fib right over here, we only want to look at day trades. You maybe want to make it where it's visible on time frames that are the current interval and below. So that means if I go to the 5 minute, it will be there, right? But if I go to even the 1 hour, that fib won't be there. So that's just something to keep in mind. So now let's go to daily, just see a bigger time frame here. And let's see, all right, where would a fib be possible? Well, of course, we could just easily draw out this fib over here for this bullish trend. And we'll just slide that over. And you could see that QQQ never really retraced to the 0.382 fib level. So what does that really signify? That signifies that we're currently in a very strong bullish trend. If we, for example, turn on the 0.236, you could see it breached below that. So if you were to inference these two things together, what you're kind of seeing here is even though the trend is strong, it will eventually soon have a reversal point. Maybe not, in the next week or two, but definitely maybe in the next month, right? So you want to always tie these things together. If you were to draw another fib, let's say this was not your swing low, but all the way back here is your fib low, swing low. You see if we draw it all the way to this swing high, you see again that the 0.38 does not come anywhere close to the retracement we had here. So what you want to try to find here is, okay, if we're not seeing it bounce off the 0.38, where exactly is the fib that's really working with this level, with this bounce over here? Because a lot of times if there's a strong bounce, best believe majority of the times there's going to be a fib that it bounced off of, and you want to have that fib on your chart because that means that strong bounce happened because the collective amount of people, whether it's hedge funds, retail traders, or whales, were looking at that fib. So that fib, let's try out over here at this swing low and at this swing high, and you could see if we bring that over, it's kind of getting closer to where that bounces. So we're like, okay, all right, it's maybe not there. Let's try this swing low to this swing high. And if we delete this, you'll finally see that this is the fib that was validated, because you held the 0.618. And if you actually move over the fib over here, you can actually see that once price broke down, the 0.38 did actually hold somewhat in this bounce over here, and the 0.5 as well. And then you could see this complete bounce off of the 0.618 move to the upside. So you could see how actually looking at the charts and trying to find the fibs that actually work are sometimes very important, because you just don't want the main question you might be thinking is, hey, if I draw a fib out here, how do I know it's the correct one, right? Well, I just answered it for you right there, real time, right? I showed you how it just takes like trial and error. You find the you know, like, okay, if it's not all the way at this low over here, maybe I need to go to the second most low, right? Or the third most low, and then you want to find where that point really works, right? You don't really change the high point in this scenario because that's where the reversal to the downside happened. So you keep the end point the same, but you try to change the starting point to try to figure out which fib is the valid one that's being validated right now, right? So that's how we would look at it on QQQ. The next ticker I was asked about was Serve. So Serve, this is a long-term trade I took. Had a beautiful setup, unfortunately, all the way till Thursday. And then, of course, Nvidia came out with the news that on Friday overnight, they came out with the news that they are reducing the amount of holdings they have for the Serve stock. So because of that, Serve kind of crept down low, and it's lost I think 40 or 50%. Tom and I both were in this trade. But if you were to draw a fib over here, there's multiple fibs you can draw. There's the fib with the swing low all the way at this point, and you would draw all the way to the swing high, which is this high over here. And you could pull it over, and you can see, well, you know, the levels that I actually have drawn out over here kind of, you know, tie in with the fib retracements we have. So we could actually go ahead and delete the fib levels that were the levels that I had before, and we could just look at the fib retracement we have. So what are we seeing here with Serve? Well, if we were very bullish on Serve, well, now we're having price break down below the 0.38, which means now that the bullish trend beforehand is not as strong as it used to be, and we're now breaking below the 0.5. So now, since I'll be upfront with you guys, I entered into shares over here. I entered on this candle. Actually, no, hold on, I'm wrong. I entered on this candle over here. So I was up. I'm pretty sure I entered here. I entered in one of these two candles. I was up pretty decent on Serve. And I didn't trim because realistically, you could see here, if you don't know fib extensions, that's different from fib retracements. Fib retracements show the reversal points and entry points versus fib extensions show the targets you can have in a trade. So if you were to look at this fib extension over here, you could see the targets I was going for, right? I was looking for the all-time highs. I was looking for above all-time highs. And realistically, if that news did not come from Nvidia, there's a higher probability that Serve would have broken out by now and could have broken all-time highs. But, you know, things don't always go according to plan. You guys saw that last Friday. You know, we had perfect setups on Shop, on what was it, Google. Google looked amazing. I still don't understand how that didn't work out. And also SMH. All of these charts had beautiful patterns and beautiful charts. I didn't enter into bad setups, but sometimes things just don't work out. So even though there's going to be times where things won't work out, you always want to use the things that will give you the higher probability of it actually working out. And that's why fibs are very important, because it gives that higher probability. Price action gives that higher probability. Volume analysis gives that higher probability. And that's why live sessions goes over that topic, because it's very important. But again, I don't know why I'm going on a rant. But anyway, so tying this together, we're seeing that Serve is breaking below the 0.5. And I entered all the way at this point, so my shares are pretty down. But the good thing is, since I'm not a complete retard, I knew that Serve is a much more riskier trade, because as you can clearly see, Serve only recently IPO'd. It recently IPO'd in 2024. So there's always going to be higher risk on stocks that are newer compared to stocks that are older, such as, let's say, Google, Amazon, Apple. You guys know that. So since there's higher risk, the nice thing is I entered into a very small position. And because of that, I'm not in huge pain right now. So what am I looking at for serve for me to add to my position, or for me to close this position? Well, I'm going to be looking at how it reacts to the 0.618. Pretty self-explanatory, right? If the price comes down and bounces off of this, would I maybe want to enter? Yeah, I could enter. What I probably would want to hope for at this point is the price actually comes a little bit below the 0.618 and like is in this golden pocket. Because if it starts forming bullish candles in this golden pocket, since it's had a very big retracement, the golden pockets are going to usually yield bigger results versus just a bounce off the 0.618. Hope you guys understood what I was saying there, because that's very important. The 0.618 is a very important level, and majority of the times, not all the times, you will find a bounce off of that area. But even though you get a nice bounce, if you get price breaking below the 0.618 and forming a bullish confirmation, whether it's you're looking at price action, RSI, MACD, whatever you're looking at, and the price comes out of the golden pocket, the push to the upside usually is going to be bigger than the push to the upside off of the bounce of the 0.618. So that is a very important thing that you want to look at, and I don't know why people don't talk about on YouTube, but it's something you want to keep an eye on. So that's serve, right? Let's look at the other examples. Amazon. So Amazon, oh, thank you. This is actually a really great example. So looking at the daily, obviously, since we're looking at a bigger time frame, our swing high and swing low is going to be like this, right? We're going to be looking at this and we're thinking, oh, wow, we're very far away from the 0.38. So what does this tell you guys? I mean, that's very simple. This trend is very strong. You could turn on the 0.236. Again, I'm personally not going to turn that on. What I'd rather do is, again, this is the bigger time frame fib, so I'm just going to keep it as current interval and above. And what I'll do is I'll go into a 2 hour. And when I go into a 2 hour, now what I'm looking at is a lot more different than the swing highs and the swing lows I was looking at before on the daily chart, right? We're looking at a much more closer interval. So we'll start drawing out the fibs on the 2 hour time frame. So this is this, actually, hold on, let me do that again. The swing low at this point is this area right over here, down at 183.69, and the swing high is all the way up at all-time highs. We move this over. I mean, I don't need to move it over. You could already see that it's not really tying up over here. Well, if you're going to be a lot more of a riskier trader, and you personally think that Amazon is going to reverse off this point, which technically it does, your next thing is you want to find the fib that ties up with this current bounce over here on Amazon. Because the reason you want to do that is because that fib will now have a higher likelihood for it being validated if price were to come down below this current low here on Amazon. So I'll show you what I mean. So we drew the swing low we identified was down here. We're going to move past that. We're going to go to this swing low just because it's you could say that's the second lowest low, right? So you draw the fib from over here, you draw it to the high. And now when we do that and we bring the fib over here, even though it's not pitch perfect, you can see here that this 0.382 fib level not only ties up over here with the reaction in price and the 0.5 as well, but it also is validating this bounce here on Amazon. So why did we draw this fib over here versus just, hold on, let me make it where it only is seen below. Why are we looking at this fib over here versus this big fib over here? Well, what I'm saying is we're not going to disqualify this fib over here. What we're seeing is we're inferencing the point that the price is so far away from the 0.382 fib on the daily, which tells us that, hey, if we think it's going to reverse, the bullish trend is very strong on Amazon. So we're now going to a smaller time frame like the 2 hour, and we're going to find the fib where we're seeing, if we believe that Amazon's going to bounce right now, we want to see which fib is going to work in line with the current bounce that's happening. So the importance of this is, let's say Amazon rallies, and it rallies over here, it rejects, and it comes down, it fizzles down, right? Now the important levels you want to look at is the 0.5, because now you've identified that this fib over here is the one that's being validated. So because this is being validated, now there's a higher likelihood that this 0.5 ratio and this 0.618 ratio is going to be validated, right? Or it's going to uphold. So that's why it's very important to see on the bigger time frames of getting a better gauge or seeing where the price is, and then go into smaller time frames to find the fibs that are being validated, because those valid fibs are going to be the ones that have higher likelihood to work in the future if the price comes down below the level that it bounced off of, right? So what I mean by the level it bounced off of is it's the bouncing off the 0.382. So if price comes below the 0.382 in the future, let's say Thursday price comes down here, you can infer that this 219.13 level, which is the 0.5 level on the fib, has a higher likelihood of working out. And then this level down here, the 0.618, is going to be even a higher probability in my mind, because we've gone over how the 0.618 or the golden pocket is going to be a higher area of likelihood for a reversal. So this is how you can use this for day trading or swing trading, because let's say Thursday comes along, or let's say Friday comes along, and I see Amazon retracing all the way here below 213.61, and let's say this is just anywhere. Again, we don't need to have the perfect 0.618 and 0.7 golden pocket. For me personally, I just know any area below 0.618, and where I would guess where 0.71 is, that's going to be the golden pocket. So if it's coming down here, if Amazon's coming down here, and I'm seeing a bullish candle on Friday on the 30-minute, and near close I'm seeing a nice curl up and I'm seeing a bounce off of this area, that's going to be a higher confirmation for me to get into calls. No one talks about this. I don't know why anybody doesn't talk about this. I don't know why no one talks about, probably because no one doesn't, is because no one talks about how important it is to find the fibs that are actually being validated. It's not just about drawing the fibs and expecting it, to work. And hey, you absolutely can. You can do that. You can wait for, if you find the bigger time frame fib, like we seen over here, you can absolutely wait for that to happen. If you are a patient person, if you are a person who's buying shares, you don't mind waiting days and weeks, you can absolutely wait for that. But also, you have to realize that when you're drawing out, especially bullish fib extensions, if you're in a bullish market, even though we are kind of waiting for a possible recession or a bearish market in the future, we're currently in a bull market. So what's the likelihood of it retracing to the 0.38 on the bigger time frame anytime soon? It's very low. And the higher likelihood of it continuing to the upside is much more bigger than it retracing to the downside. So that is why it's very important. No one talks about this. This is probably the first time you heard it. If you haven't heard about fibs before, it's very important in my eyes to find the fibs that are being validated, because when you do that, you're finding areas and levels that will be very strong to look at, whether it's for day trading and swing trading. So that's Amazon. I know I went on a whole spiel, but I hope that helped. All right. What's another example? So let's do Google, and I'll get into your questions after we do Google and then Reddit. You guys, by the way, you can start typing your questions, because I think I went over. Wait, was there? Oh, you guys also typed in the live session chat. I'm sorry. I'll go over your tickers after I answer the question. So if you guys don't mind, if you could ask your question about fib retracements right now, and I'll answer them after I go over Google and Reddit. So Google is a really great example as well. And before I continue, let me just take a sip of water. So Google is a really great example because Google's been on a very strong trend, and it's kind of broken down after breaking all-time highs. So you can see here, if we're on the daily time frame, let's just figure out the swing lows, swing highs. We'll draw out the bigger one. The bigger fib is all the way down at the swing low, all the way up here to the swing high. You can see right now that the price is currently very far away from the 0.38 level. So what we'll do is we'll go onto the 4 hour. We'll go to a more recent time, and we're gonna find the swing lows here. So the swing low is down at this area, and this swing high is over here. And you could see, if we actually move this over, that this fib is likely the one we want to look at, unless Google were to continue breaking down. So those are the fibs you want to look at. And if we go to 30-minute, I'll make this even simpler. If we're looking at 30-minute, you can see the swing lows all the way down here. So we'll take the swing low, we'll find the swing high, which is all the way at this point. We'll move the fibs over. And when we move the fibs over, we're seeing quite a few things here. We're seeing that on this fib, the price has broken below the 0.38 very strongly. And not only that, after it bounced somewhat off the 0.5, it was unable to reclaim the 0.38, which means it didn't even test it. So which means the bearish momentum is very strong. So when you see that, you could kind of infer that any bounce is more likely going to be short-lived compared to a rejection to a downside. So maybe inferring that, let's say if this didn't come over here and we see this breakdown below 0.5, we're then thinking to ourselves, okay, all right, we broke below the 0.38, we broke below the 0.5, we didn't even come and test the 0.38 after the bounce off the 0.5. Maybe I don't want to really get off of bounce or try to test a bounce on the 0.618 bounce. Maybe I want to see a pop, in the golden pocket to take a trade off, right? That's kind of what happened here. And this fib right here that you see me drawn is actually a fib I was looking at when I was trading the Google calls from Thursday to Friday, because we were in the golden pocket, right? You could see we bounced off the golden pocket, and just so you could see what I mean, I'll turn on the 0.786, right? Anywhere between here is the golden pocket. So you could see here that it bounced once, not really twice, but twice over here, and then a third time. So if we had Google shares, for example, and not options, you could look at this as a bearish channel. And bearish channels always, not always, but the majority of the time always break out to the upside. And we could see here that we're also in the golden fib, or the golden pocket. So we actually want to be a little bit more bullish, because the second, the price comes above the 0.618 level, because it's already in the golden pocket area, we could see a very strong move into the upside. And that's why I got the Google calls. But unfortunately, we should have technically had a breakout on Friday, but we didn't, and we just simply didn't. It's unfortunate, because that was a pretty big red day for us. But if this was any other day, and Friday wasn't a weak trading volume day, which it was, by the way, that's why a lot of setups were invalidated, the breakout would have happened, and you would have had a much more better result on Google. So now we can see here, now that we're creeping even lower into the golden pocket, and we're attempting to create this is kind of an equal low. So now you're trying to create a higher low at this point. And the second Google creates a higher low, that's a bullish trend. And then you're back looking at testing 190, 192. You can use the previous fib levels, the 0.5 and the 0.38 as targets, or you can use the fib extensions, which we've talked about before. The last ticker I'll go over before I go over your guys' questions is Reddit, sorry. And I'm glad you brought this up, because this is another stock that's been parabolic, and this definitely trend is very strong. So we want to figure out, hey, Reddit, let's say we think Reddit is a very strong long-term growth stock, right? You can see here, if we draw from the swing low to swing high on the daily, you can see that the 0.38 fib was already respected in the past. So I personally do not want to delete this fib. I want to keep it, because we could see here that it's been respected in the past, even though this swing high did not exist. So the fact that it's bouncing off the 0.38 fib over here signifies the importance of that area. So what we'll do here is we'll go over to 4 hour, go to a smaller time frame, and we'll kind of find out where the more recent swing highs and swing lows are. Well, the swing high is still going to stay the same. We're going to look over here. We're going to look at the swing low down over here. We're going to draw it. And we could see here again, this fib that we drew from this fib low, not this fib low, the swing low, is still tying up with this fib level with this hesitation over here. If I, for example, and I'm actually curious, if I make this where I can view it, you can see that this is the fib we just drew right now. It's a little bit higher than the fib that we drew on the daily time frame. So maybe this is a fib I want to keep a closer eye on. And now if we want to just get a little bit more riskier levels to see where it could possibly bounce off of, we could come to this swing low over here, and we could use this swing low, find the swing high, and we could see that the 0.38 kind of lines up with the let me delete this because it's a little confusing, with the swing, oh, not the swing, but the range high of this range over here, right? Because you could see here, if we draw out this range, you're seeing that this is the top of the range. So going through these examples, what you could kind of see here without me saying it is it's always important, in my experience, to have more than just one fib on your chart. Because one fib, yes, it could absolutely work, and if you're fine waiting for it, yeah, you can absolutely wait for it to retrace those fibs. You could absolutely do that. But if you tie in multiple fibs on different time zones and time frames, you could catch the trade at a much more efficient time, or you could try to catch multiple trades more compared to waiting for the trade to wait all the way to your, your bigger time frame fib and waiting for it to bounce over there. Again, this is all risks and risk management things you guys have to figure out. But this is just me putting the education out to you guys so you can kind of infer what you want to look at. Now I'm going to go over the questions you guys have. You guys can post in either chats, and I'll go over them. So I'll just go over the main chat first. Is this the fib we're talking about? Absolutely. If we're talking about ICT, yeah, absolutely. All right. Let's see. I would like to see fib retracement for EAT. Should I be getting back into stock for options? I'll go over that later. How do we draw a fib retracement for a stock like Walmart, which doesn't ever seem to retrace much? Good question. I think that kind of answered that, but we'll go over Walmart very quickly. As I said, when you have very strong stocks that have very strong sentiments, you could see how strong Walmart has been. It's really not had any strong retracement. So you might be thinking, okay, where is fib's going to really be valid here? Well, obviously, if you draw the daily fib, it's not going to be as valid or not as valuable because the fib is all the way down here. And yeah, if you're a long-term investor, of course, draw it out. You can wait till it retraces there. If you're more of a short-term or a short-term swing trader and you want to wait for a better retracement, you then want to go into a smaller time frame. You could maybe go into 4-hour, 2-hour, 30-minute. Again, you have to go to these time frames. You have to draw the fibs out, multiple fibs. Find the fibs that work. Find the fibs that look like it's going to be more prone to being valid. So let me show you, because this actually ties to a question that Silent Trees asked over here. Could you go over what you meant by validating and drawing fibs? Let me show you what I mean by that on Walmart. So let's just go to the 4-hour. Let me delete the daily fib, or let me just make it where the daily fib only shows on the daily. If we go to the 4-hour, we kind of zoom in. So now the swing low is no longer this swing low. We now have a swing low that's a little bit more recent. So the swing low we have on the 4-hour chart is down here. And we'll draw this out, and we'll see this right here. So when we draw this out, we'll see, okay, all right, how can this fib be valid? Well, you could see right here, the fact that it's bouncing off, the price is bouncing off the 0.382 fib validates this fib level. Why is that the case? Because if we go back again, before that high was made, where our endpoint was, you could see that the endpoint over here, which we drew, which was the high, that high was not created. And even though that high was not created, the fib was still holding over here, which means this fib did not even exist, and price was still holding above that point. So now because of that, we can infer that this is a valid fib. So now that we're on the 4-hour, obviously price is still very far away from where the fib is. So if you're a little bit more risk adverse, you would just go according to this and you'll think, okay, all right, I will personally wait for price to retrace here to this fib level, see how it reacts, and maybe I'll enter. Let's say you're more prone to, or you're more willing to take on more risk. You want to see where there are more closer entry points for Walmart, because you've seen, as we've seen on the daily, Walmart has just been parabolic, and you might think it's still going to continue onto the upside, right? I'm stuttering here. I'm sorry. I'm just talking for a long time, so I'm kind of stuttering. But let's say we want to kind of find a closer fib to the current price. We then will go to a smaller time frame. So from the 4 hour, for example, we could go to 2 hour. And from the 2 hour, now we have new swing lows and swing highs. Well, not new swing highs. It's the same swing high. We will draw the swing low. Sorry, I just don't want to clutter the screen. So let me make it where it shows only on 4 hour. Let's go to 2 hour. Now it's cleaner. Now that we're on the 2 hour, we're going to use this swing low down over here. And we're using this swing high. And when we pull this over, you'll see that you could kind of see it's not much difference than what the previous fib was showing, right? Because it's still around the same area. If we go to a 4 hour, you'll see it's not that much different. So maybe if we're more willing to take on risk, maybe that's not where we kind of want to look at. Maybe you want to raise the starting point to the second lowest low in this time frame. And that's over here down at 72.52. When we do this, now it gives us a little bit better entry points here for Walmart, because now we're all the way at the top of the range. So now this top range gets even further validated as an area of interest for where I'd potentially want to enter into calls. So now I would draw at this level at 92.70 because that ties into this fib level. And if, for example, Walmart were to retrace down here, I would be looking at taking calls if my confirmations add up. Let's say I'm even more riskier. All right, let's delete this level right here. Let's make it where it only shows on this interval. Let's say I'm even a more riskier trader, and I believe, hey, Walmart is going to keep continuing to the upside. It's going to continue, 10% more from where the price currently is. I think it might have one retracement, but I want to make sure the retracement I get into is going to be, I'm not going to miss out on the trade, right? Again, putting on more risk always has its downsides and its upsides. Feeling like you're going to miss out on the trade always has its significant downsides. But if that's who you are and you're more prone to taking on risk and you have your reasons to taking on more risk, power to you, right? All the power to you. Do what works for you. But now on the 30-minute, which is smaller than 2 hour, of course, we're finding the new swing low, which is down here, and we're using the same swing high. And now we have levels we want to look at. Now, how do we know this fib is a valid level, or this is a valid fib? Is because we can see prior to this fib even existing, we could see price reacting to these areas. So that means there's a higher likelihood if Walmart were to retrace to this area, there's going to be either a reaction here or here, right? Or anywhere along these fib levels. So Silent Trees, hopefully that answers your question about how I basically figure out how a fib is validated. And DK, I hope that answers your question about how to find fibs on a very strong sentiment, a strong bullish stock like Walmart, which seems like it's not even making its, very powerful retracements. It's going to be basically doing that, right? If you are seeing a stock consistently going higher and higher and it's not having very strong pullbacks, the reality is you would have to technically take on more risk in trying to enter the trade, because you would have to go into smaller time frames and look at where the fibs are to kind of tie it in, right? And again, I'm going to just do this one last time. If you want to be even more riskier, again, you could keep doing this. You could go onto different time frames. You could figure out what works for you. You could go to a smaller time frame. You could go to the 5-minute. You could find the swing low, right? This new swing low, which is down here. You could find the swing high. And when we draw this, look at this. How is this fib valid? Well, because before this fib existed, we could see that the price reacted to these areas, right? 0.38 kind of reacted in the middle of this, right? So this now means if the price were to retrace to this point, there's a high likelihood that it's going to bounce off of those fibs. Another way you can use fibs is if, let's say, you already had a level here at, what is this? Let's just say you had it here at, let's say, I can't choose. 102, right? Let's say you had a level at 102, and a fib you drew lines up with that level you drew out beforehand. That gives a little bit more validation to the level you're looking at, or the level you had drawn out previously. So yeah. All right. What are the questions? It might be different for other people, but I've always known the golden pocket is 0.618 and 0.65. Absolutely. That's not a wrong comment as well. If you want to be a little bit more stricter in terms of your golden pocket kind of criteria, you can reduce it from being between the 0.61 to 0.78 all the way down to the 0.618 to the 0.65. So thank you, Junester, for bringing that up. Again, it's all your criterias and what you want to look for. Yeah, the price action video is probably going to take like 3 hours or 4 hours to go over, so that's going to be a whole live session. I mean, I'm getting tired over here talking for an hour and a half, so I can only imagine that day. So do we adjust fibs as the day goes on to new highs and lows? Also, may I ask why you jump to 2 hour? Does the 4 hour and 1 hour work as well? Well, first of all, I'm going to answer the second question. I personally time frames are usually up to personal preference. I personally love the 2 hour, 30 minute, and the daily. Those are my time frames I love looking at. If I were to rank my favorite time frames, number 1 is the 30 minute, number 2 is the 2 hour, and the number 3 is the daily. So yeah, it's up to preference. And it doesn't mean that the fibs only work on a 2 hour and the fibs only work on the daily. No, it works on any single time frame. But of course, since we talked about, again, previously on the on the presentation I was talking about, unfortunately it disconnected my tablet, but you want to go with the time frames that the collective group is looking at, right? So obviously people are going to be looking at the 2 hour, the 30 minute, the 4 hour, the 1 hour, the daily, versus, let's say, like the time frame which I'm trying to create to become the new popular one, the 22 minute. Like, who the hell is looking at the 22 minute? Only the retarded Kevin is, right? So maybe, it really depends on your kind of preference there. If you feel like a lot more people look on the 4 hour versus 2 hour, which, by the way, is a fact, more people look on the 4 hour, then you could just use the 4 hour and the 1 hour, because you believe more people look at the 4 hour and 1 hour, right? Because again, the reason why fibs work is because humans follow patterns, and because traders have identified that humans follow patterns, collectively as a group, we now look at that levels as areas of support and resistance, right? That's why fibs work. So you want to go with what the collective group is looking at. Hopefully that answers your question. Now, the first part to your question was, do we adjust the fib as the day goes on? Very simply, the way I can answer that is it depends on what your priority is, and it depends your risk. With the examples I went over with Walmart, right, and the example before that, you could see it's basically based on risk. If you, for example, are trying to day trade and you're seeing Nvidia, for example, going up and up and up, if you're seeing it go up and up and up, you're most likely going to, if you're okay with taking risk, you then want to probably maybe adjust your fibs, right? You want to adjust it to the to the new highs it's making, right? So what I mean by that is, let me go back onto this. Let me just create a new page. And I like drawing and writing. That's why I'm doing this, and I think it explains it easier. If Nvidia is creating higher highs, and let's say you drew a fib that was like this, right? There's this starting point, there's the end point. Obviously, let's say Nvidia goes up even more. You then change your fib where it goes up like this, and this is your end point, and now your fib's like this, right? But then Nvidia goes up even more. Yes, you could keep changing it, but you have to realize that you're opening yourself up to more risk. The more and more you adjust your fibs while the price action is going on, the more risk you have to theoretically think that's more risk I'm okay to take on. If you are not okay taking on risk, maybe then what you'd want to do is just stick to the previous fib you want to look at. Or if you're not okay with taking risk, instead of looking at the 5 minute, which is, let's just say this is the 5 minute, you'd rather want to look at the daily chart, right? And then you would want to probably draw out your fibs like this. You know, let's say this whole 5 minute chart is in this small little retracement here. Let's say we're just having a little bounce, and this is the retracement over here you're seeing. The 5 minute, this is just the daily chart over here. Maybe you want to go according to this fib on the daily chart because you want to be less risky. If you want to be more risky, absolutely, then you can go ahead and adjust your fibs. But again, one crucial point that I talked about, which again you will not hear anywhere else, is you want to make sure your fibs are valid. You can't just draw a fib and expect it to work, because when you do that, you know, you want to again go with the collective group. So you want to find the fibs that are valid. And again, we talked about how you find the fibs that are valid, where it lines up, where the price basically lines up with those fib levels previously, right? So hopefully that answers your question. It actually would really help if you guys can tell me if it answered your question, just so I can make sure I go back to and answer again if I didn't. So yeah. So how do you move the fibs on the chart like that? Oh, so all it does, I'm on a laptop right now. So if you click on the fib and you use the arrow keys. So if you click on the fib and you hold the left arrow key, then it moves to the left. If you hold the right arrow key, it moves to the right. So fibs is not always the lowest point. It is determining on which low point, which high point C level works. Yes, that is a great way to think about it. And again, another way to think about it is how much risk you're willing to take on. Fibs are very amazing, but again, the main question is, hey, how much risk am I okay taking? And if you guys don't know how much risk you're okay taking, maybe you could refer to the resources channel where I typed up my whole thing here about how you could potentially figure out what your risk tolerance is, what your risk plan is, so on and so forth, right? Many resources here you guys can look at. And there's previous YouTube videos as well. Soundries, I hope I answered your question here, because I gave a lot of, yeah. This guy, by the way, this is my friend, so he's just joking around with me here, so don't take him seriously. PayPal, MasterCard, yeah, I'll go over that later, buddy. How do you integrate the golden pocket into ICT concepts? Well, what I do is I basically remove people like you from the VC, and then I go according, and then I answer that question, all right, buddy? But yeah, I'm just joking with him. But Kev, what confluences do you personally use for fibs? That's a great question. This kind of ties into what I was kind of showing here. When I was talking about confluences, for me, it's mostly price action. So it's kind of, you know, you guys know me, I like getting into bullish trades. So if I'm seeing bullish candles off of a, you know, a bounce off of a level, a fib level, that kind of shows me like, hey, you know, this fib level is most likely going to work. If we go, for example, to, a good example is Amazon. I forgot what time frame it was. I think it was a 30-minute, 2-hour... 4-hour. Well, basically, let's say I'm looking at this and I'm seeing, right? I'm seeing here. Oh, wait, no. What was that example? Nvidia. There we go. Nvidia was that example. If you go to the 5 minute, you can see here, right? This is my confluence or confirmation, right? You have two candles that I like. I talked about how I like these candles. Other confluences I use or confirmations is VRVP, right? We have a video where I deeply went into VRVP and points that people don't talk about. And if, let's say, the VRVP is also lining up with my fibs and it's also bouncing off of that fib level, then I have a little bit more confidence in my fibs, right? Also, another thing is, let's say a level lines up with my fib retracement, then that's also another added confidence to me potentially taking that trade. Hopefully that answers your question. I'll check that out later. Jam, is that? Yeah, that's Randy, by the way. What volume indicator are you using on the right of your chart? I just said that, so that's the volume range. That's a visible range volume profile. I have a very, very nice video talking about it, because I talked about things that no one else talks about. And if you go to a live recording section, if you go to a link section, this is the more important part. If you go to links, if you guys haven't, it will be very helpful if you click on this link, and what you'll get here with the trend, the bigger trend. Oops. And two, I don't like hearing my voice. I think it looks very boring. It sounds very boring. But if you click on that link, you'll pull up our YouTube channel. Please subscribe. I mean, you know, JP and I put a lot of work into this. And at this point, you know, the main thing we want to grow is our YouTube channel, because it's satisfying to see it grow. So make sure you subscribe to us. But if you click on this link and you come to our YouTube channel, after you subscribe, you go to a video section and you scroll down, and you can see we have a bunch of videos that I've recorded and that JP has co-hosted here with me on live sessions. And there's a lot of things you can learn. If you don't know volume analysis, there's there. If you don't know pivot points, that's there. If you don't know MACD, that's there as well. I talk about why enter the last 5 minutes, right? If you have all those questions, most likely or not, I have already answered them in videos. And if you scroll down, you'll see, where is it? To answer your question, you'll see this video over here that says how to use VRVP, and that is the volume indicator you'll see on the right side of your chart. So there's a lot of resources that you can find on our YouTube, which will actually answer a lot of your questions. So definitely take a look at that. You can fall asleep to my boring monotone voice. A lot of people have admitted to doing that. I'm completely okay with that, right? So yeah, take a look at that. All right. Oh, cool. We get a question from JP. Do fibs also line up with the breaker block on the... Okay, you know what? I thought JP here was gonna give me a real question. I got happy for that for a second, JP. But yeah, that's up to you guys to decide if you want to follow retarded ICT concepts. Excuse my language. Alright, that's not a question. I'll look at it later. Thanks for answering that, Randy. Once you figured out you have more than 2 brain cells. And there he goes back to having 1 brain cell. Alright. I fell asleep watching the Millionaire video. Yeah, I mean... yeah. Alright, let's look at the other questions you guys posted here. Is there any questions here? That's you guys talking with JP earlier. Okay, so can you repeat that? The bounce is higher if it gets down to the 0.168 or the 3 point. Did I answer your question, or would you want me to go over that? Let me just go over very quickly. I think I could go over very quickly without boring you guys. Again, we have all these levels. The main ones I'm looking at is the 0.38, 0.61, and the golden pocket. So when it comes to bounces, think of it like this: the lower something retraces, the bounce usually, like if the retracement's very big and very strong, if there's going to be a bounce, it's going to be very strong, right? We're not talking about dead cat bounces, we're talking about actual reversals. So if you logically think about it, you know, yes, of course, you can have, just like the Walmart example, you guys saw Walmart, right? If you're looking at more closer time frame fibs, the 0.38 is probably going to be followed by a decent bounce. But once you're actually looking for a decent reversal trade, the 0.618 or the 61.8 ratio is going to most likely have the second biggest bounce or the reversal movement that you would want to get into. The first or the biggest reversal movement is when you get your price action coming out of the golden pocket, right? So when the trade is coming out of the golden pocket, that is where you see the bigger moves happening. So me personally, I like getting into trades that are usually in the golden pocket, or if I find a very strong trend and I see a nice bounce off the 0.38, I don't mind entering off of these as well. But the 3 places I'm looking is a 0.38, 0.618, and the golden pocket. And my preferred zone is the golden pocket. All right. Hopefully that answers your question. Unfortunately, JP has to head out because I kind of held him past his bedtime. So, yeah. So see you, JP. What is the flow volume? Yeah, I answered that question. All right. So I guess that's all the questions for, what's it called? Do you guys have any final questions about fib retracements? It would really help if you guys can either ask your questions right now instead of me answering later on, or at least tell me if this was easy to understand or complicated to understand. Because if this was complicated, then I need to work to create another second video and addressing the points that were complicated to you guys. So you can at least, yeah, I mean, I'll be completely honest. I thought I pretty made it easy. Yeah. The only real hard part that it's really going to be up to you guys to decide is figuring out what your confluences are. Again, I can't hold your hands. I'm not a financial advisor. You guys have to figure this out, right? So you have to figure out what are your entry points and what are you going to do? Are you going to go according to price action? Are you going to go over according to RSI? Are you going to go over according to MACD? It really depends. If you have a strategy that's working with you right now, if you have a strategy that's working for you right now, let's say you use the RSI, let's say it's working for you, right? Why fix something that's not broke? That doesn't mean you can't add things that will supplement to your trading. So if you're using RSI and divergence, you can now probably try to figure out where the fibs are to probably get better entries and maybe up your success rate with your RSI trades. If you're a price action and volume trader, you can use the fib levels to validate the current levels you have to kind of figure out how the strength of the trend is without using indicators like the RSI and the MACD, and you can figure out entry points, right? So there's multiple things. You can't really figure out, hey, what's the best way to enter off of fibs based off of, just this right now, because you would have to look separately at all the videos or your own thoughts about, certain indicators. For example, maybe for me, I know for a fact, I personally think, and this is just my opinion, price action beats everything, right? I think you could figure out everything you need to know off of price action and volume. But a person like JP thinks, hey, price action is great, but I find most of my success off of moving averages and MACDs. So he will look at the MACD. For example, he's the one who presented this. So he already has his knowledge on MACDs and he has his knowledge on moving averages, and he could tie that in with RSI, with fibs, right? If you don't know the MACD, and let's say you don't have a solid strategy, then your job is to go out there and actually learn. And I'm not talking about learning about things that are just stupid and dumb, like ICT concepts. And I know I keep on ragging on it because I've been dealing with it for like so many years, and I think it's 3 years, and I'm just completely done with the utter nonsense I hear from it. There's no such thing called FVGs and freaking silver, bronze, gray ass bullets, right? There's just price action, patterns, levels. And the thing that pisses me off is the fact that this guy took price action, made it into a very minimized version of it, and gave names to make you think that you're very smart in what you're trading. And you'll realize the reason why a lot of people who are ICT traders are quiet these days is because they're most likely liquidated or wasted all their money on trades, because ICT concepts is a shorter time frame trading and scalping kind of trading strategy. And scalping, if you've realized yourself or if you've seen other people, usually does not work out in the long run. You need to be on some sort of kind of Adderall or something to be attentive every single minute, and you need to have no emotions, because scalping will play with your emotions. So that's my last rant on ICT. I don't know why I went there again, but you get what I'm trying to say. Yeah, so easy to understand, but I believe we have more questions. Absolutely. I applaud you guys to test this out and to have questions about it. And you guys can, let's say, the next live session we're going to do, I forgot, I had to check what we have planned to do. Like after that live session ends, we're usually around for a quick Q&A session. You can ask those questions there, and I'll be on, or JP will be on to answer it. This might be asking a lot. Could you guys make a video on the Saturday or Sunday about price action patterns, chart analysis? I know that won't be a quick hour task. Yeah, I will. That's absolutely the point. Just like I talked about 2 live sessions ago, I'm not trying to hold it from you guys because I want to hold it until the end and keep you guys here all the way to the end. It's because I believe there are a lot more important things to learn before price action. Because as I said, if you tie all of the things I teach you together, that's how I learned. And I said it before, I learned about how the MACD, the RSI, Bollinger Bands, pivot points, moving averages, SMAs, VWAP, these are all topics we'll go over. But I learned all of these, and I've read up about all of them. And when I did that, it's what helped me understand the market in such a way that is unique. because it's not me gloating about my ability to understand what's going on, but it's just a fact, right? So yeah, I will eventually get to it. I will, but there's a lot more things that I need to cover before we get to that point. So do we target a fib level or a fib extension when we close? Very good question. Okay, hopefully I'm gonna I'm gonna give you a very easy answer. Hopefully it's easy to understand. With a stock like Walmart that is consistently making higher highs and is breaking all-time highs and making new all-time highs, fib extensions would be better for targets, because you're not really retracing to lower fib areas, right? So you can't really use the fib retracements as targets. Versus, let's say, for example, let's say you enter in, whoops, that's the wrong fib. So if I draw a fib extension here, I'm just drawing one, right, very quickly. Let's say I draw this one over here, and let's just say I enter. I'm looking at the fib extensions, I'm obviously not looking at the fib retracements. But let's say we go to Google. Since it is not significantly, but it is away from its all-time highs, that's when I can actually use the fib retracement levels as targets. So since, for example, we have this fib right here, since I am in the golden pocket, and let's say I take calls because I believe Google will go up this week and next week, my targets are going to be the 0.5 first, and then the 0.38 for runners. Because, yes, I can draw a fib extension. You definitely can, right? Like if for example, you drew it like this and drew it like this, right? You'll see your first targets all the way up here about at 203. Which again, if you guys don't know fib extensions, they're one of the most beautiful tools you could draw. I personally like them more than fib retracements. You can watch this video right over here, how to find levels at all-time highs. Basically, fib extension, you could use that as basically finding targets for your trades. But you use fib extensions when you're looking to be a lot more riskier, because you're looking for much more higher targets. So the fib extensions you use for runners. But fib retracements, if you're getting into a trade that's in a lower fib area, then you would use the fib retracement areas at levels as your exit or trim areas. So I would be looking to exit majority once we are coming close to the 0.5, and I'd look to trim my runners even more if we hit the 0.382. And if I have runners and we come above the 0.382, but what I'm trying to say is, if we break above the golden pocket and we break above the 0.5, but we break back down below the 0.5, that will give me indication that I might want to exit out of my runners to secure some of that profit, because there's now a higher likelihood that it's going to break down back again to the 0.618, or even lower than lower in the golden pocket. So hopefully that answers your question. Yep. All right. So you guys didn't have any questions on here? All right. So that's I'm gonna wrap up this part. I'll stay on for a few more minutes, but that's my whole rant about fib retracements. I think I personally will advocate it. Again, I'm not a financial advisor, but in my opinion, I think it's one of the most easiest and best tools you can use. And not only will it give you possible entry points, it will help you identify trends a lot more easier. So if you are, I'm sorry, I'm going to be completely blunt here, but if you're an idiot and you're finding yourself fighting against a trend, if you force yourself to try to find these fib retracements, the first things you have to do, as we talked about, is find the swing low and swing high, no matter what time frame you're looking at. And when you do that, you're already training yourself without even knowing to figure out what the trend is, right? Because obviously if the swing high is very far away from the swing low and you're drawing yourself a bullish fib, you're looking at a bullish trend, right? So it's really great. And I've always been an advocate for, even if you always want to place yourself in environments or habits that will enforce better trading habits. That's why I think scalping is horrible. That's why I'm not a huge advocate for prop firms, or high frequency trading. Because prop firms, for example, yes, you can get payouts. You could get multiple payouts. You can make money quickly. But let's say prop firms goes away. And prop firms, what it did to you is it spoils you with these high frequency trades and over leveraging and having all these things going your way. And then let's say prop firm goes away and you're like, okay, all right, I'm going to trade options now. And you start realizing that, hey, now data is a factor. And, you know, you start trying to do high frequency trades and you start finding yourself burned out, where you're finding your trades getting burnt. Because you put yourself in a bad habit where you did high frequency trades on the prop firm, you will 100% see it affect you when you switch to options trading. That is just like, I've not seen anything else that's proven me otherwise. So you always want to look at things that will put you in places where you're following good trading habits, because that is clearly and really a thing. So again, I really hope this helped. It seems like you guys understood it. So yeah, all right, I'm gonna thank you guys for coming on for the Fib retracements part. I'm gonna stay on here for the last few tickers or questions. But again, if you're here for a Fib retracements part, I'm gonna end it here. So thank you again for joining us.